Every century has its crash. 1929, 2008, and now 2025. We stand at a precipice, looking out over an economic landscape that feels both familiar and terrifyingly new. We've seen booms and busts before. The Roaring Twenties, a decade of unprecedented prosperity, ended in the silence of the Great Depression. The housing boom of the early 2000s, built on cheap credit and risky mortgages, collapsed into the Great Recession of 2008, wiping out trillions in wealth. But this isn't just another correction. This isn't a simple market cycle. Many leading economists are sounding an alarm, warning that the next downturn won't just be a recession, it will be a structural reset, something worse than anything the modern world has ever seen. Why? Because for the first time in history, everything is connected. Every asset class, every nation, every part of the global economy is intertwined in a complex web of debt and leverage that has reached a breaking point. Let's look back. In the crash of 1929, the stock market plummeted an astonishing 89%, taking over 2 decades to recover. Long lines for bread and work became the defining image of a generation. In 2008, the S&P 500 fell 57%, and the foreclosure signs that dotted suburban landscapes were a stark reminder of how quickly the American dream could become a nightmare. But in both cases, there were places to hide. Government bonds, for example, were seen as a safe haven. This time, the story is different. It won't just be stocks, it won't just be housing. Bonds, commercial real estate, private credit, and even the bedrock of the financial system, government debt, are all flashing red. For years, central banks have pumped the world with cheap money, pushing interest rates to zero or even negative. This unprecedented monetary experiment has inflated not just one bubble, but a series of interconnected bubbles. Stocks, housing, bonds, they've all been rising together, not because of fundamental value, but because of the endless flow of artificial liquidity. Analysts have a name for this phenomenon: the everything bubble. It's a world where traditional safe havens no longer exist. When one part of this system fails, the risk of a domino effect is immense. There's nowhere to run, nowhere to hide. The most visible part of this problem is debt. It's everywhere, and it has reached levels that would have been unimaginable just a few decades ago. Look at the average household. Credit card balances have soared to record highs, surpassing $1 trillion in the U.S. alone. Families are using debt to maintain their standard of living in the face of persistent inflation. Then there's the student loan crisis. An entire generation has been saddled with a staggering $1.77 trillion in debt, a burden that delays home ownership, marriage, and starting families. It's a massive drag on the economy, a promise of a bright future that has turned into a lifetime of payments for many. But personal debt is just a fraction of the story. Corporate debt has exploded. In 2008, U.S. corporate debt stood at around $2 trillion. Today, it has ballooned to over $10 trillion. Companies, encouraged by low interest rates, have borrowed aggressively, not always to invest in new factories or innovation, but often to buy back their own stock, artificially inflating share prices and executive bonuses. This has created an army of zombie companies, businesses that don't earn enough to even cover their interest payments. They only survive by rolling over their debt, a game that can't last forever. And at the very top of this pyramid of debt is the U.S. government itself. For years, the government has been running record deficits, spending more than it takes in. The national debt has surged past $34 trillion and is climbing by $1 trillion every 100 days. The situation has become so extreme that the interest payments on this debt are set to become one of the largest expenses in the federal budget, larger than defense spending. The government is caught in a debt storm of its own making, and its ability to act as a backstop in a crisis is more limited than ever before. But debt, as terrifying as it is only the surface. Beneath it lies something far more hidden and far more dangerous. The real threat is leverage. Leverage is the hidden multiplier in the financial system. It's the tool that allows banks, hedge funds, and institutions to make massive bets with relatively little money down. It's what turns a small market shift into a global meltdown. And today, the scale of this leverage is beyond comprehension. The derivatives market, a web of contracts like options, futures, and swaps whose value is derived from an underlying asset, is estimated to be worth over $600 trillion. Some estimates put it closer to $1 quadrillion. That's more than 10 times the size of the entire global economy. Think about what that means. For every real dollar of economic output, there are hundreds of virtual dollars in financial promises, all interconnected, all dependent on a fragile system of trust. These aren't just numbers on a screen. They are a network of counterparty risks. Your bank's health depends on another bank's health, which depends on a hedge fund, which depends on a foreign government's ability to pay its bonds. It's a chain of promises, and if one link breaks, the entire chain could shatter overnight. We saw a preview of this in 2008 with the collapse of Lehman Brothers. But today's system is infinitely more complex and interconnected. The flashing red numbers on trading floors are a constant reminder of this fragility. The system is built on confidence, the collective belief that the music will keep playing. But when that confidence evaporates, and history shows it always does, and often suddenly, the rush for the exit is merciless. The virtual promises vanish, and all that's left is the scramble for real, tangible assets. We see the calm surfaces of our daily lives, children playing in suburban parks, shoppers strolling through malls, a sense of normalcy that feels permanent. But beneath this surface, the financial tectonic plates are shifting. The charts that have only gone up for a decade are beginning to show cracks. The foundation is unstable. The question is no longer if the crash will come. The conditions are set. The imbalances are too great to be sustained. The everything bubble has reached its limit. The real question is how deep it will go. When stocks, bonds, and real estate all fall at the same time, what happens to our retirement accounts? What happens to our jobs? What happens to the social fabric that holds us together? This isn't about fear-mongering. This is about understanding the enormous risks that have been built into the system. It's about recognizing that the prosperity of the last decade was not built on a solid foundation, but on a mountain of debt and a web of derivative promises. When the tide finally goes out, we will see who has been swimming naked. The next crash will redefine our world. The challenge is not to predict the exact day it will happen, but to understand the forces at play. Because when it does, the impact will be felt in every household, on every street corner, and the world that emerges on the other side will be very different from the one we know today. Have you ever wondered what would happen if the entire global financial system just stopped? We're not talking about a simple recession or a stock market dip. We're talking about a full-blown reset, a moment where the very foundation of our modern economy cracks. It's a chilling thought, but understanding it is the first step toward preparing for it. Today, we are going to explore a scenario that many economists fear, but few dare to discuss openly. The day the dollar dies. Imagine this. The scene opens not on Wall Street, but everywhere at once. Times Square, the bustling heart of New York, goes dark. London's financial district, silent. The neon glow of Shanghai and Tokyo, extinguished. One by one, the world's economic centers are plunged into an eerie quiet, their vibrant energy replaced by a stark, ominous red glow reflecting off financial charts plummeting to zero. This isn't a localized crisis. This is global. There's a saying in finance: when the U.S. falls, the world follows. But why? It's because every major economy today is deeply, inextricably wired into the same network, the dollar system. Think of it as the world's operating system for money. It's not just about the cash in your wallet or the balance in your bank account. It's about the very mechanics of global commerce. Every day, colossal container ships filled with everything from iPhones to avocados cross our oceans. Massive oil tankers navigate the seas, fueling our industries and homes. Trillions of dollars flash across international payment networks in the blink of an eye. What do all these things have in common? They are priced, traded, and settled in U.S. dollars. The dollar is the lifeblood of global trade. It's the reserve currency held by central banks from Beijing to Berlin, the unit of account for corporate loans, and the benchmark for commodities worldwide. This system works as long as everyone trusts the dollar. It's a delicate balance built on confidence. But what happens when that trust shatters? When the U.S. government's debt spirals so high that investors start to question its ability to pay it back? When the Federal Reserve's policies create not stability, but chaos? When that happens, the trust that underpins the entire system evaporates. And when trust disappears, liquidity dries up. Not just in America, but everywhere. This isn't just a theoretical problem. The dominoes are already lined up. Look at China. For decades, its economic miracle was built on a mountain of debt, particularly in its real estate sector. Now, that property bubble is in the midst of a spectacular meltdown. Ghost cities and unfinished apartment complexes litter the landscape, a monument to unsustainable growth. Millions of citizens have their life savings tied up in properties that may never be completed. When the world's second-largest economy faces a crisis of this magnitude, it can't be contained. Now, let's turn to Japan. The land of the rising sun is slowly drowning in a sea of debt. Its government debt-to-GDP ratio is the highest in the developed world, a staggering figure that makes your eyes water. For years, the Bank of Japan has kept interest rates at or below zero, desperately trying to stimulate an economy that has been stagnant for decades. This has created a fragile, artificial environment. If global interest rates spike because of a U.S. crisis, Japan's debt bomb could finally detonate. And what about Europe? The continent is trapped. It's caught in a brutal tug-of-war between crippling inflation that erodes people's savings and the looming threat of economic stagnation. Energy crises, geopolitical instability, and a banking sector still recovering from past wounds make it incredibly vulnerable. There's a reason for the old market adage. When the U.S. sneezes, the rest of the world catches pneumonia. But this time, it might not be pneumonia. It could be a terminal illness. So let's connect the dots. The U.S. dollar, the linchpin of the global system, starts to wobble. Maybe it's the bond market that breaks first. The yield curve, a reliable predictor of recessions, doesn't just invert, it shatters. Foreign investors, terrified of holding a depreciating asset, dump U.S. Treasury bonds en masse. To stop the bleeding, the Fed is forced to hike interest rates to astronomical levels, choking off what's left of the American economy. Simultaneously, the currency markets go into a frenzy. The dollar's value collapses, and the prices of everything imported, from oil to electronics to food, skyrocket. Hyperinflation isn't a distant threat from history books. It's happening in real time. The trust that held the system together is gone, and that's when the real panic begins. Picture the scenes we saw in 2008, but on a global scale and amplified 100-fold. People rush to their banks, desperate to withdraw their life savings, only to find the doors locked and the ATMs dark. Electronic payment systems fail. Credit cards are declined. The digital money we've all grown so accustomed to simply vanishes, its value wiped out. The stock markets don't just crash, they close indefinitely. The flow of credit that businesses rely on to operate, to pay their employees, to produce goods, it seizes up completely. This isn't a recession. A recession is a cyclical downturn. This is a reset. It's a fundamental reordering of the entire economic structure. The paper wealth that has been built up over decades, stocks, bonds, derivatives, even cash, is revealed for what it truly is, a promise. And in a crisis of this magnitude, promises are broken. But in every great collapse throughout history, there are always winners. The winners are not those who held on to paper promises. They are the ones who held real, tangible assets. Things you can touch, things that have intrinsic value, things that can't be printed into oblivion by a central bank. Think about it. When currencies fail, what holds its value? Gold and silver. For thousands of years, they have been the ultimate safe havens, the money of last resort. They are nobody's liability and carry no counterparty risk. When the financial system implodes, precious metals don't just survive, they thrive. What else is real? Land. Farmland that produces food, property in strategic locations. The ability to produce the necessities of life becomes the most valuable commodity of all. Food itself. In a world where supply chains have broken down and supermarkets are empty, a stockpile of storable food is worth more than any stock certificate. These are the eternal safe havens, the assets that have weathered every storm, every empire's fall, and every currency's collapse. History doesn't repeat itself, but as Mark Twain supposedly said, it often rhymes. We saw the patterns in 1929, with the Great Depression. We saw a glimpse of it in 2008, when the global banking system was pushed to the very brink of collapse. The warning signs are flashing again, perhaps brighter than ever before. The question is, are we paying attention? Are we preparing for the rime of 2025? Because every bubble, no matter how big or how long it lasts, ends the same way. It doesn't end with a loud pop that everyone hears at once. It ends with a deafening silence. The silence of factories that have stopped producing, the silence of trading floors that have gone dark, the silence of a world waking up to a new and much harder reality. Thank you for watching. If you want to understand the forces shaping our world and learn how to navigate the challenges ahead, make sure to subscribe to Economics Explained. We're here to help you make sense of the collapse before it happens. Stay informed, stay prepared, and we'll see you in the next video.